Welcome to the Deep Dive.
Yeah, this is where we sift through the earnings calls.
Exactly. We cut through the noise, pull out the crucial details for you, the experienced investor.
And today we're tackling SunOpta's first quarter 2025 results.
Right. Looking at what management said, where they're heading, the whole picture.
We'll get you the highlights, the key drivers, the strategy. Basically what you need to know.
Okay, let's jump in. SunOpta Q1. What's the big story?
The main headline, outperformance. Simple as that. Q1 beat expectations.
A good start.
And good enough that they actually raised the bottom end of their full year guidance.
Okay, let's get those snapshot numbers then. How did Q1 actually look?
So top line, revenue hit $202 million. That's up 9% year over year.
9%, okay. Driven by?
Volume mostly. Volume was up 12%. Pretty strong.
12% volume growth? Yeah, that's significant. But what about margins? Higher volume doesn't always mean better margins immediately.
True. And adjusted gross margin was 15.3%. Now that is down from 17% last year. But crucially, it was up sequentially from Q4. And management really hammered that point home. They expect that sequential improvement to continue.
Right. So the trend is moving upwards quarter over quarter. That's key. How did that flow through to the bottom line?
Well, adjusted EBITDA, that came in at $22.4 million, again, ahead of what they were planning for the quarter.
Okay.
And adjusted earnings from continuing operations, $5.3 million. That works out to 4 cents per diluted share.
4 cents. Up from what, last year?
Up from 2 cents per share in Q1 2024, so double the EPS year over year.
Double the EPS, okay. Revenue up, volume strong, EBITDA beating plan.
Yeah.
How's the balance sheet holding up with all this?
Looking stronger, too. They paid down another $4 million in debt just during the quarter.
Sequentially.
Sequentially, yeah. Total debt's now $261 million. And that helped their leverage ratio, debt to adjusted EBITDA, drop to 2.9 times.
Down from 3x at year end.
Exactly.
Yeah.
Progress there. And cash flow from operations was really robust, $22 million.
Compared to?
Just $7 million in Q1 last year. So a big jump in cash generation.
Okay, that all sounds pretty positive. Strong operations, improving balance sheet, makes sense they'd raise guidance. What are the new targets for fiscal 25?
Right. So based on that Q1 beat and the visibility they feel they have, they nudged up the bottom end. Revenue is now expected between $788 million and $805 million.
Which implies what kind of growth?
That tightens the range to 9% to 11% growth for the year. Previously, it was 7% to 11%.
Got it. And EBITDA?
Adjusted EBITDA guidance is now $99 million to $103 million. That's projecting 12% to 16% growth. Again, raising the floor from the previous 9% to 16%.
So they're feeling more confident about hitting at least the lower end, maybe better. Let's dig into why. What's giving them this confidence, this revenue visibility?
They broke it down into a few key areas. First, just the strength of their categories.
Okay.
Their core markets are growing well. Self-stable plant-based beverages, for instance. They actually bumped up their growth expectation there now, looking for high single digits this year, up from mid-single digits before.
And acceleration in plant-based. Interesting.
Yeah. And then you have things like better-for-you fruit snacks and ready-to-drink protein shakes. They see those growing over 15%.
Wow.
Even the more mature categories like broth and tea are contributing, expected to grow mid-single digits. So broad-based category strength.
So they're in the right places. What about their actual customers? Are they winning with their key partners?
Seems like it. That was their second point. Customer and channel strength. Their top 5 customers, the big guys, all grew year over year in Q1.
That's always a good sign.
Definitely. And specific channels are performing well too. Food service saw mid-single digit growth and the club channel was up double digits.
So hitting on multiple fronts there.
Yeah.
And they often talk about diversification. How does that play into the confidence?
That's the third pillar, really. It gives them resilience. They're spread across those growing categories we mentioned: plant-based, fruit, broth, protein, tea. Within plant-based, they work with oat, almond, coconut, soy. So they're not overly reliant on one specific base.
Flexibility.
Right. And they serve different channels: retail, club, e-commerce, food service.
Yeah.
So if one area slows down, others can potentially pick up the slack. It helps them adapt.
Okay. Good category, strong customers, diversification. But what about new growth? What's really driving that forward look, especially beyond this year?
That's where the new business pipeline comes in. And this was a pretty striking number they shared.
Where was it?
Their current pipeline of potential new business. It stands at almost 25% of their annual sales volume.
25%. That seems Really significant.
It is. Management explicitly stated that's double, twice the level they saw over the previous 15 months or so.
Double the pipeline. Okay. What's in there?
It's a mix. Taking market share, expanding the total market, launching new things. They noted the typical conversion cycle is, 6 to 18 months.
So not immediate revenue, but...
But the sheer size and momentum of that pipeline is what gives them a lot of confidence in hitting their longer-term goal of around 10% annual revenue growth. It really underpins the outlook for 26 and beyond.
That pipeline number is definitely something to watch.
Yeah.
Okay, let's switch gears to margins. We noted Q1 was down year over year, but improving sequentially. They have a plan, right? A 4-point plan.
Yep, exactly. Focused on operations and efficiency. The first point is capacity creation, getting more out of their existing assets. And they're making progress.
How so?
Well, in their aseptic network, the liquid processing volume production was up over 6% sequentially in Q1. That follows similar growth in Q4.
Okay, building momentum.
And in fruit snacks, they produced 7% more units in Q1 25 than Q1 24 using the same equipment.
So squeezing more efficiency out.
Pretty much. And the key thing here is they said they are significantly ahead of schedule on unlocking this capacity.
Head schedule.
Yeah. They claim they've already created enough capacity headroom to support the midpoint of their entire 2025 revenue guidance.
Wow. So that sort of de-risks the top line guidance quite a bit, doesn't it? If they know they can actually make the stuff.
Exactly. It shifts the focus more towards converting the pipeline and managing the execution rather than worrying about hitting a production ceiling this year.
Okay, so they have the physical capacity. How does that translate into better margins, though? That's the other side of the coin.
Right. That's where the other 3 points of the plan come in. These are about operational execution, and they expect the impact to really show by Q4 this year.
What are they?
First, fixed cost leverage. As you push more volume through the same plants, those fixed costs get spread thinner. They're targeting about 150 basis points of improvement from that.
1.5%. Okay.
Second, optimizing manufacturing yield. Getting more sellable product out of the raw materials you put in. Think less waste, better recipe adherence, maybe smart substitutions. That's targeted for about 100 basis points.
Yeah, 1%.
And third, labor productivity. Just getting more efficient with staffing, processes, training, aiming for about 50 basis points there.
Okay, so add those up. 150, that's 300 basis points.
Yeah.
Or 3% potential margin uplift from those operational levers by year end.
That's the target, yeah.
Right.
But there's one specific headwind they're dealing with at one particular plant.
Yes, the Mid-Lothian facility in Texas. What's the issue there again?
It's a wastewater bottleneck. Basically, due to a combination of the regulatory environment and their current system being a bit undersized for the volumes they want to run, they have a temporary limit on how much they can produce there.
And that hits margins.
It does. It limits maximum output, and it also means they're incurring extra costs. They're having to pay about $500,000 a quarter in extra fees just to haul wastewater away while they work on a permanent fix.
$500,000 a quarter.
Yeah.
Ouch. When's the permanent fix coming?
The timeline they gave is mid-2026. They were upfront that this wasn't something they anticipated way back, but they stressed that the limitation and those $500K quarterly costs are already baked into their guidance for both this year and next year.
Okay, so it's a known drag,
Yeah.
factored in. What's the upside when it is fixed in mid-26?
Well, beyond just eliminating those haulage fees, they estimate that resolving the bottleneck could boost total company gross margins by about 50 basis points.
Another 0.5% lift across the whole company, starting in the back half of 26.
Exactly. It's another layer of margin expansion layered on top of the operational plan.
Okay, so putting this all together, what's the expected journey for adjusted gross margin from the 15.3% in Q1?
Right. So 15.3% in Q1 25. They're guiding for 18% to 19% in Q4 25. That fourth quarter is always their seasonal peak because of the broth business.
Got it. Then into next year.
They expect Q1 of 26 to be about 200 basis points better than Q1 25, so around 17.3%. For the full year 2026, they're aiming for that 18-19% range again.
And the longer-term target.
With continued execution and that Mid-Lothian fix coming online, they're targeting hitting 20% gross margins sometime in the second half of 2026.
Okay.
And sustaining 20% plus for the full year 2027. So it's a clear roadmap they've laid out.
A multi-year margin expansion story. Okay. Seems like they have a decent handle on operations, despite Mid-Lothian. What about external stuff, like tariffs? That's been in the news.
Yeah, they tackled that head on. First, context. SunOpta is overwhelmingly U.S.-based. 6 of their 7 plants are here. 98% of their 24 revenue was to U.S. customers.
So limited direct exposure.
Well, they do source some raw materials and packaging globally, and they import some fruit snacks from Canada, but that's less than 8% of total revenue.
Okay, so what's their plan if tariffs hit those inputs or imports?
Their strategy is pretty straightforward. Pass through essentially all of the incremental costs to customers. They said they started having these conversations back in January.
Treating it like a raw material cost change?
Exactly. If costs go up, they pass it on. If costs were to go down, presumably they'd pass that back too.
What does that mean for the financials, though, if they just pass it through?
They expect to recover basically all the extra costs, maybe with a small time lag. The critical point they made is they do not expect a material impact on their gross profit dollars or their adjusted EBITDA dollars.
But the percentages might look weird.
Right, because revenue goes up by the amount of the tariff pass-through, the gross margin rate and the adjusted EBITDA rate could look lower as percentages just because the denominator revenue is bigger. But the actual profit dollars should be protected. That's key.
That is a key distinction. Protect the dollars, even if the rate fluctuates.
Okay, let's shift to capital allocation. How are they planning to use their cash?
They updated their priorities. Very disciplined approach. Priority number 1, which they hit end of last year, was getting leverage below 3 times.
Check. What's the current number 1 priority?
For 2025, it's all about getting leverage down further, specifically targeting 2.5 times by the end of this year.
Why that specific 2.5x target? They mentioned conviction in their long-term growth and needing financial flexibility. Getting to 2.5x gives them more room to make future growth investments, whether organic or M&A, without getting over-levered.
Makes sense. How are they funding that debt pay down?
They were very clear. Essentially, all of their expected free cash flow in 2025 is going towards mandatory debt and notes payable repayments to hit that 2.5x goal. They also said they don't see a need for major growth CapEx this year.
So 2025 is the year of deleveraging. What happens after they hit 2.5x? What's priority 2?
Priority 2 becomes investing back into the business, specifically capacity expansion. They see that as the highest return use of capital for long-term value.
More production lines.
Potentially, yeah. They'll keep an eye on market trends, customer demand, and weigh the returns of building new lines versus maybe looking at M&A.
Okay, and priority 3.
Returning capital to shareholders. And on that front, they just got board approval for a new $25 million share repurchase authorization.
A buyback authorization. Interesting. That live now? Are they buying back stock?
They called it an opportunistic tool. The actual timing and amount of any buybacks depend on hitting that 2.5x leverage target first.
So delevering comes first.
Absolutely. Then they'll look at their overall financial health, other needs, market conditions. But they could use it if they get ahead of schedule on deleveraging and have extra cash while still hitting the target.
So it's there as an option, signaling confidence, but debt pay down is the main game for 25 cash flow.
That's the message, yeah.
Okay, putting it all together.
Yeah.
It sounds like they're executing pretty well in a consumer environment that still feels a bit shaky for some companies. How did they frame their performance in that context?
Yeah, that came up. Their view is that their categories plant-based, the health-focused snacks, protein, broth are somewhat insulated.
How so?
They see them as lifestyle choices, maybe perceived health necessities, or small, affordable treats that people are less likely to cut back on drastically.
Less discretionary, maybe.
Kind of. Plus, they emphasize their key customers are performing well, often outpacing the broader categories. And SunOpta itself fills a need in the market, providing reliable capacity, consistent quality, innovation, things customers value. So it's a mix of good categories, good customers, and being a needed partner.
And the fact they're ahead on creating capacity.
Yeah.
That must reduce risk around hitting those revenue numbers.
Absolutely. It means the physical capability is there. It puts more emphasis on sales execution and converting that big pipeline, less worry about production constraints this year.
And the Mid-Lothian issue, while a drag, sounds contained.
They were clear it's fully baked into guidance for 25 and 26. The fixed timeline seems plausible. It's a known headwind, not a new surprise that could derail things unexpectedly based on their commentary.
Got it. Quick clarification. SG&A expenses were down in Q1. Should we expect that lower run rate to continue?
No, they flagged that, said it was mostly timing related to stock comp adjustments, not a new sustainable level for G&A costs.
Okay. And the yield improvements for margins, is that an easy fix?
Apparently not. They described it as complex, involving lots of different aspects of production. It's progressing, but maybe a bit slower than the capacity unlocks. Needs ongoing focus.
And raw materials generally, tariffs aside. stable.
Generally stable, yeah. They saw some minor price givebacks, like on oats in Q1, but expect things to be relatively steady otherwise.
Finally, that share buyback authorization. How should investors really view that $25 million?
I think you view it as a signal of confidence and a tool they gain once the primary goal, 2.5x leverage, is achieved. It provides potential upside. If they execute well, delever faster, generate more cash than expected, they have the authorization ready to go. And for a company their size, $25 million, if deployed, could actually move the needle, especially if the market isn't fully appreciating their progress.
Okay, good context. Right, let's switch gears. This is our not financial advice segment. Purely hypothetical trade ideas based only on what we heard in SunOpta's call. Think like a hedge fund analyst pitching an idea.
Pure thought experiment, based only on the call data.
Okay, pitch number 1, the Mid-Lothian miracle trade.
All right, the idea here is go long SunOpta, maybe stock, maybe some longer dated call options, say expiring late 2026.
The thesis.
The market gets the cost of the Mid-Lothian bottleneck, now the $500 a quarter haulage fee, the production limit. But it might be underpricing the benefit when it gets fixed mid-2026. Management quantified that fix as potentially adding 50 basis points to total company gross margin.
0.5% across the board.
Exactly. Combine that 50 BPs lift with the ongoing progress on the other margin. Levers the leverage, yield, labor productivity, and the conversion of that huge pipeline. Suddenly, that 20% plus gross margin target for 2027 looks a lot more credible.
So betting on the market rereading the stock as that higher margin profile becomes clearer.
Precisely. The $500 quarter saving is nice, but the bigger story is the structural margin uplift enabling that 20% plus goal. It's a known CapEx project, so execution risk is there, but if they deliver, the earnings power and unlock could be significant.
A longer-term bet on operational execution and infrastructure. Okay. What's trade idea number 2?
This one's shorter term, the leverage and lagging buyback play. Consider buying SNA stock or maybe calls expiring around the end of this year, end of 2025.
Okay, what's the angle?
Management couldn't have been clearer. Priority 1 for 2025 cash flows hitting 2.5 times leverage by year end. They just beat Q1 expectations and said they're ahead of plan.
So the bet is they hit that 2.5x target early.
Or at least demonstrate a very clear path to hitting it comfortably before year end. Once that key deleveraging target is demonstrably met or exceeded, that $25 million share buyback authorization becomes a live tool.
And the market might not be pricing that in yet.
Potentially not the timing or the impact. For a company SunOpta's size, activating even part of a $25 million buyback triggered by hitting a major publicly stated financial goal could be a meaningful catalyst, especially if free cash flow is coming in strong. You're betting on that sequence. Beat plan, hit leverage target early, trigger buyback sooner than expected, positive stock reaction.
Interesting. One longer-term operational bet, one shorter-term financial catalyst bet, both derived straight from the call's narrative.
Purely based on the commentary and the numbers they provided, yes.
All right, that brings us to the end of our deep dive on the SunOpta Q1 2025 earnings call.
So the key takeaways. Strong start to the year, leading to that guidance raise, good visibility on revenue growth, driven by solid categories, strong customers, and that really impressive pipeline growth.
Yep, and a clear plan in place for margin expansion over the next couple of years, focused on operational levers, even with that Mid-Lothian headwind factored in.
Plus, a strategy to manage external factors like tariffs by passing costs through, aiming to protect profit dollars. And that disciplined capital allocation, delever first to 2.5x, then invest with the buyback as an opportunistic tool later.
And just to reiterate, everything we discussed today is based on our interpretation of the earnings call. It is absolutely not financial advice.
Definitely not. Do your own homework, check the source materials yourself.
But hopefully this deep dive gave you a quick, insightful summary of SunOpta's recent performance and outlook.
Yeah, let us know if there are other calls or topics you want us to unpack.
Thanks for tuning in.